Hi, my name is Kristof Gleich. I'm the president and the CIO of Harbour Capital Advisors. I'm delighted today to be joined by Bo Knudsen, who's the CEO of Sea Worldwide, an internationally and globally focused money manager based out of Copenhagen. And welcome to Views from the Harbour. Bo, welcome to Chicago. It's a bit rainy today.
A bit rainy, yeah.
Maybe a bit like Copenhagen.
Very much the same.
On some days. So you're based out of Copenhagen. You've been running concentrated stock portfolios focused on global or international markets for over 30 years, since 1986. So most investors around the world have some form of home country bias. I think nowhere is that more true than in the US. And actually, if you're going to make the case in any one country where that should be more true than less true, maybe it's the US. So why, with everything that's going on today, why should an investor here consider investing overseas?
It's interesting to get exposure to unique revenue streams. I think that's actually key.
Mm-hmm.
And there are some of the greatest companies in the world listed here in the US, and there are some of the greatest companies in the world that are listed outside of the US. So you get access to unique companies, for example, in the robotics area. Well, there are certain Japanese companies that are exporting the Kaizen principles of Japan. This has been in Japanese culture for hundreds, some would even claim thousands of years.
Yeah.
And it is refined to an extent, and there are companies that are selling products and services and unique revenue streams that you get access to that you don't get access to at the same level here in the US, with all due respect to the US companies. There are some very unique companies and revenue streams outside of the US.
So there's some world-class companies in the US and outside of the US.
Definitely.
You mentioned Kaizen and Japan and robotics.
Yeah.
That's clearly a theme. We'll come on to some themes more shortly.
Mm-hmm.
But you make an interesting point, because I sometimes think we, as investors, think too much in sort of binary terms. It's either you own all non-US or you own no US.
Yeah.
You're an active stock picker. You're an active manager. Yeah. And you have this rule, this discipline of no more than 30 businesses. And I use the word businesses rather than stocks very deliberately.
Yeah.
Because you want to own partial shares, partial ownership of different revenue streams, growing revenue streams. So talk about why 30? Is there a magic or science behind 30? But also, how do you sift a universe of potentially thousands of different investments just down to 30? That must be pretty tough to do.
Yeah. So the founding principle of the firm was, let's limit ourselves to 30 stocks and then look at alternatives in this constant competition for capital. So that is a founding principle, and we've never wavered from that. I can witness that after my more than 25 years in the firm. So that's extremely important. So why dilute your own capabilities, if I may say so, with a principle of a maximum of 30? We get to the point of having a portfolio where we control risk, and at the same time we have a level of conviction in what we are owning. So every stock makes a difference in a 30 stock portfolio, and that's key for us. You get a certain level of diversification, but at the same time you hold on to the level of conviction with that principle in mind. So that's the why 30. It could have been 25, it could have been 35. We decided early on that 30 is our magic number.
So you get the balance of conviction and diversification, not diversification, in terms of like a concentrated portfolio. And then how do you focus on those 30? Because there must be a lot of businesses that you could be tempted to invest in. How do you focus on your portfolio of 30? What kind of criteria do you look for?
Yeah. So it starts and ends with the existing portfolio.
Mm-hmm.
So every day we look at the portfolio and we compare and contrast if there's something out there on our pipeline, in our research assignments list, that is more interesting than what we have in the portfolio, with a 5-year perspective in mind. That's very, very important. We think that the opportunity as an investor in the 2020s is what you could call time arbitrage, just taking a longer term horizon than the average investor. And I respect the term of margin of safety. I respect the term, and I know that there are very distinguished investors that talk about the margin of safety as an attractive valuation.
Yeah.
With all due respect, I would disagree.
Mm-hmm.
We consider our margin of safety as the business model, the strength and the sustainability of the business model. We talk about a right to win, a permanent right to win. Can we identify companies with a powerful, permanent right to win, with a strong, profitable business model that are working with thematic tailwinds in their back, and a driving force behind the growth? So that's our margin of safety. It's the business model.
It's definitely a different take on margin of safety, and an important one. And you talk about sustainability of earnings growth. Resilience isn't a word that you use, but I think that's important. You're looking for businesses with resilience and probably a high degree of sort of flexibility and agility to evolve as the world changes. One of the things that I think that you do very well is your use of sort of thematically oriented research to help identify secular trends and sort of keep you pointed, your true north, pointed at the longer term. Mm-hmm. What are some of the themes that you're invested in today? What are some of the themes that investors should be aware of as they look out over the next 10 years?
First of all, we share our knowledge through a number of white papers when it comes to themes. We are stock pickers, but we align our stock picking with the world and how the world changes. So our primary window into top down is themes. A key theme that we are emphasizing now, and we think is going to be with us for a number of years, is the move where governments are playing a more significant role in societies. And whether you like it or not, this is something that is a consequence of developments in the world, the great financial crisis followed by COVID, and then followed by the situation and the more and more mention of the world war.
Yes.
This creates an environment where we're looking in the direction of governments to solve problems and to solve growth and drive growth. And so the government agenda becomes a bit more important in an environment like this. And there are some shifts happening that has government support. And we are talking about a green transition happening. This is happening across the globe, Asia, Europe, and to some extent the US, with the IRA being the latest example of a driver of government support in that direction. On top of that, we had the reshoring happen. What's the bottom line here? We think that there are a lot of factories that are going to be built. We are going to see a shift on the margin from manufacturing in China to manufacturing in the Western world, in the US and in Europe. A lot of modern factories are being built. So this goes back to the robots. What do you think that a factory of the 2020 is going to look like? It's going to have a lot of automation, a lot of robots. It's
a lot of sensors.
A lot of sensors, a lot of modern solutions. So yes, this is a more tangible world, but you will see a lot of intelligence being built into those factories, those tangibles. We talk about intelligent tangibles.
Yes.
And obviously there's been a lot of talk about software eating the world, and we continue to believe that software is important. We just see a world that becomes more tangible, and we see an investment wave over the next decade, an investment wave where more factories are going to be built, and where we see intelligence being built in, and where there are certain unique companies, a number of them from the US, but also a number of them being companies outside the US that is going to benefit from this.
So whereas through the 2010s, software eating the world was a dominant theme, and we may be transitioning to one where software is still going to be very important, but there are other longer term themes, perhaps driven by government policy, whereby countries like the US want to start re-onshoring, and to re-onshore effectively and build factories of the 2020s, focusing on businesses that provide solutions for, I want to make sure I got this right, intelligent tangibles.
Yeah.
So how to build modern day factories, that might be a good way to kind of concentrate your research agenda and find businesses that would benefit from that thematic tailwind.
Yeah, where you get where there's an extraordinary compounding opportunity. If you find a business model, margin of safety business model, sustainable business model, strong returns on capital dynamics that can benefit from this shift. So yes, we're going to need a lot more cement, pipes. When you build a modern factory, you need basic commodities. We think that is a tougher area to invest in. There are opportunities in the picks and shovels space there, but still there are other elements of a factory of the 2020s and the 2030s where we think there are some companies delivering products and services to that's going to benefit.
I think it's an important reminder. There's many ways to construct a portfolio and think about the world.
Oh yeah.
Markets generally on the whole are pretty efficient, but one way that you can create value is by this time arbitrage that you talk about, and marrying some deeply structural trends that are happening in the world, and marrying that up and finding businesses that can ultimately benefit from that. So Bo, thank you for joining us today. Really interesting to hear your views of the world. And we hope you all enjoyed this episode of Views from the Harbour. Thank you.
Thank you, Chris.